When you are an analyst or you want to buy stocks, you have to have compounded thinking. So that compounding machine has to sit in your head, not in the computer. But then one table they have not told is the power table of 2 raised to power 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I do the table in Hindi. So 2, 4, 8, 16, 32, 64, 128, 256, 512, 1024. So 2 raised to power is 1024. So roughly 2 raised to power 10 is 1000 times.
I think the real difference happens from 2 to the power of 9. 2 to the power of 8, it is still, somewhere around
256.
250. And 2 to the power of 9, suddenly it became 500.
Yeah, so the base has that power, no?
Yeah, 2 to the power suddenly 10, suddenly 1000.
So now, how does it work in real life in investing? Person is built by how you handle your savings. Nations are built by how the nation handles its own savings. So in newspapers, I read 4 newspapers in the morning. The businesses built out of nowhere, like NVIDIA. I didn't know how to pronounce it 3-4 years back. Today, NVIDIA is the largest company in the world, and it has been still growing at 70-80%. You should be master of your own tool. My tool will not help you. Your tool will help me, because you have built your entire thinking around that particular tool. Like EBITDA doesn't work in my head. EBITDA doesn't work in my head. Yesterday I was there somewhere. He was only telling EBITDA. I said, give me the PAT. Because it just doesn't work for me, EBITDA. I want PAT. Really, you have gone through all the wealth creation studies. In fact, it is all kind of coming, getting refreshed in my mind when you show me the graphs and all. Everything is part of one study or other.
Yes, sir. Hello everyone, welcome to Zerodha Varsity videos. Thank you so much for joining us today. Today, I'm really excited to be here with Mr. Raamdeo Agrawal, the man from Motilal Oswal. He needs no introduction, but spare me a minute to explain or give context to what we're going to learn in today's video. Equity investing is all about future. We have to predict what the company's profits are going to be, what the cash flows are going to be, how the management will take corporate actions, how the industry is going to perform. It's all about the future. But we also know that future is very uncertain, and then taking predictions is very dangerous sometimes. So, to counter the risks of the uncertainty of the future, we need to have deep understanding of the past. To understand the Indian markets for the past 28 to 29 years, and I've been releasing an annual wealth creation study every single year. If you haven't gone through these reports yet, I'm sure that you are missing out on a lot. The analysis of these reports is everything based on Indian companies, Indian brands, what worked for them and what didn't work for them. And through this study, it is very clear that Mr. Agrawal and his team believes that investing in quality companies with focus on growth creates long-term wealth for investors. So in this video, let's learn from the man himself on what it is about growth investing and how we can implement them in our investing style. So thank you so much for joining us. It's a real pleasure to have you here.
No, thanks for coming, Satya.
So there are so many styles out there like value, momentum, the contra investing and then market cycles. Why do you think investing in quality growth stocks can create long-term wealth for investors like us, small investors like us?
So quality and growth are, quality and growth are the only two sources of wealth creation itself. Wealth creation, forget it listed or unlisted. But at a corporate level or at a business level, the value is created or wealth is being created by being high quality company. Okay. Then growth is an added, multiplier to the already wealth making machine. So wealth is being made. So let's be very, very simple. Let's come to the ground. As if you are not even a chartered accountant or a BCom student. How exactly you make wealth? I give you 100 rupees. And you make it 125, 130, 140, 200. So the guy who makes 200 every year, he creates faster wealth and bigger wealth. If I give money to you and you make it 110 and your sister makes it 200, who is better? Your sister is better. Okay. So the quality comes in there. So what is my ROE? Return on equity. So it's like a bank deposit. You go to bank, the deposit rate is 5%. But say HDFC Bank gives you 5%, SBI gives you 6%, and ICICI Bank gives 7%. Where will you go? All the three banks are good banks.
Yeah.
You'll go for 7%. It is like that. But this is known in the kind of a slate. When you ask for you go anywhere, you can figure out who is giving how much for the same. You'll find all of them giving same. Okay, but in the stock market, it doesn't happen like that. There will be the companies which might be earning 100%, and yet it might be treated like a company which is earning hardly 10%. So that ignorance or lack of information or what I call, I would say lack of information or even companies not displaying this information. But now with digital platforms, information is all available. And that's why markets are becoming far more efficient. The data flow till about, say, digital platforms came turn of the century. And of course, the Excel sheet and all came in 90s. And I used first desktop sometime in 87, 88. Since then, data has been flowing. But till 95, we were looking for a physical balance sheet. That itself was a big, availability. I think turn of the century, digital, and particularly when the internet started coming on phone, I mean, literally you have everything flowing so smoothly on phone. You go to screener. I mean, any company is available, full thing.
Yeah.
And then on top of it, now you have the AI-led growth and you can ask a whole lot of things. So for an individual investor, knowing what is a good company is not that difficult. And hence market will become more efficient. Now, what is a good business and what is a good management? What is growth and what is valuation? These are four components in my mind. That's all in investing. How well you judge all the Q, G, L, P as a component. That's where the research and practice and experience and how good you are in judging them into the future is crux of investing.
Understood. So this power of compounding, I mean, I went through the 2017 annual wealth creation study. In that, where you've taken the companies that have performed well from 1997 to 2017. Right. And there are companies like Infosys, Imami, Eicher Motors, Sun Pharma, HDFC Bank, Asian Paints, Britannia Industries. All these companies have grown at the rate of 25% to 30%, and a few companies even more than that. Now, to give perspective to our readers also, to understand this, power of compounding. A person, an investor who invested at around rupees 1 lakh in 1997, if they invested in an index fund, Nifty 500, they would have received about 15% return, and that 1 lakh would have become 16.3 lakh or something like that. But had they invested in any of the companies that I just mentioned in the report also, at 25% CAGR, it would have become 86 lakh. I was like, how? I mean, the difference between 16 lakh itself is too good. Now 16 lakh to 86 lakh, the difference is the human brain is not wired to understand this level of compounding.
So that you touched very good point, and my sense is it still remains a dark continent of investing, in the sense that compounding, which is so easy to understand. If you know multiplication, division, addition, and so you can do compounding. And concept of compounding is known to everybody. Everything in life is CAGR, CAGR, compounded annual growth rate. So when you said 15%, it is CAGR.
Yeah.
When you earn 5% in bank deposit, it's a CAGR.
Yeah.
So everybody knows compound annual growth rate. Most of the guys may not be doing what does CAGR stands for and how exactly it works in maths, interest on interest. So, but then what happens is that on a computer or you can do it on a calculator. But when you are an analyst or you want to buy stocks, you have to have compounded thinking. So that compounding machine has to sit in your head, not in the computer.
How to develop that?
Yeah, so it is. See, one of the mistakes in our arithmetic program in schools, they do all the multiplication table, 1 to 20 tables, we mug it up. We know all 1 to 20 multiple. Because we know that 1 to 20 table, we can do compounding. We have the birthright to know the compounding. Without that 1 to 20 table, you cannot do it. But then one table they have not told is the power table of 1 raised to power, 2 raised to power 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I do the table in Hindi. So 2, 4, 8, 16, 32, 64, 128, 256, 512, 1024. So 2 raised to power is 1024.
Yeah.
So roughly 2 raised to power 10 is 1000 times. Okay. So knowing this table is extremely important. So when you want to plan your wealth,
Yeah.
say you are a young guy, say 25, 27, 30, you are making say a crore or 50 lakhs or whatever. And everybody wants to be a billionaire in life, isn't it? Everybody wants to be financially independent. Somebody's target would be 100 million, somebody's target would be $1 billion. So how exactly I achieve there? See, so you have to use the compounding because nothing can turn from a crore to 10,000 crores overnight. But there is a journey.
Yeah.
There is a journey. You set your journey, compounding journey, and it'll all work out. If you give, say, like, if I want to make 10,000 crores, that is about a little more than $1 billion. From a crore, that is 10,000 times. Now, 10,000 times, at the rate of 10,000 times, at the rate of 25%, in 40 years, my 1 crore become 10,000 times.
Wow.
Okay. So now for next 40 years, I have to see. So I have decided about becoming a billionaire in next 40 years and enjoy this journey. Now what do? I make sure that every year my 1 crore grows by 25%. So first I invest in something which actually gives me 25% return. Okay. Now at times the investment itself may not give you 25%. It might give say 18%, 20%. Then 6-7% I must make it up from my savings, from my current earnings. So I have a salary also. I have a 50 lakhs rupees salary. So of that, say after spending 25 lakhs I must put in that 1 crore. So 1 crore itself will grow by 20%. So that will make it 120. Plus you put in your 25 lakhs. That makes it 145. So at what rate you have grown? 45%.
Wow.
Like that you have to build a machine.
Yeah.
So initially, since the base is small, you can contribute your savings plus the investment income, and the machine might do at 35%. Now, the moment you've done 35%, do you know in 10 years, when you do it 25%, your 1 becomes 10 crores.
10 crore.
Okay. But at 35%, how much it will become? It will become 20 crores. Okay. The moment you have done 20 crores, your residual return requirement is no more 25%. It might come down to 23, 22%. So you just keep doing things. That's what Buffett did. Buffett started with the modest sum in 1963 and he kept on growing at 20%. And now he's not growing at 20%. But initially he grew at 25, 30% and created a huge base. And now he's growing at maybe 12%, 15%. And still his long-term performance is 19%, 20%.
I think this perspective is so new and fresh to me that you don't have to earn entirely from the investment itself. I mean, I can earn by saving, I can earn by increasing my salary.
But knowing the game is very important. How your savings are growing.
Yeah.
That is very important. People are so casual about their savings. They'll go and buy, they'll give to somebody.
Yeah.
They'll put in some bank deposit. Or it is just lying in bank account, not earning anything. Or they will do some absolutely unviable investment, or they'll give in some startup and that money, the guy will take away the money. You have to be very careful how you handle your savings.
Right.
Because you will be as good as how well you have handled your savings. Person is built by how you handle your savings. Nations are built by how the nation handles its own savings.
Fantastic. So when you talk about that 2 to the power table, I think the real difference happens from 2 to the power of 9. 2 to the power of 8, it is still, somewhere around
256.
250. And 2 to the power of 9, suddenly it became 500.
Yeah, so the base has that power, no?
Yeah, 2 to the power suddenly 10, suddenly 1000.
So now how does it work in real life in investing? India is growing at about 9% dollar. So rule of 72.
Yeah.
So in 8 years, India is doubling dollar GDP. Dollar GDP. So this is happening for last 25 years. So now I'm at $4 trillion per annum. I will go to $8 trillion in 8 years flat. By 2032, 2025 plus 2033, 32, 33, we should be around 8 trillion. Give or take 1 year. If rupee is stronger, it could be even 1 year earlier. If it is little weaker, maybe 1 year more. But that's what is going to happen. In 33 will be 8, and by 2040 will be 16. So this is a very steep journey. What you done in 75 years, you'll do in next 8. And what you will do in next 85 years, you will do it in next 8. So this journey is going to be extremely exciting. I wish I was a little younger with this knowledge.
You still look younger. Sir, but picking these growth companies is not very easy. I mean, had I been in 1997, I wouldn't have actually, or like most people like us investors, it's very difficult to pick those companies and sit for such a long time. But I think you have created a framework for yourself, which is, as you mentioned, QGLP, which is quality, growth, longevity, and price. For investors who are watching this, if they want to understand what is a quality, I think when you talk about quality, you refer to the quality of the business and quality of the management.
You're right.
If they want to know how to assess the quality of a business, what should they look into?
Yeah. So quality of business is extremely important. So you must read page 6 and 7 of Berkshire Hathaway 2007 report. Great, good, gruesome. I think Buffett's best 2 or 3 pages are those. In last 40, 50 years of, not 40, 50, I think 70 years of his writing, 65, 70 years of annual report writing.
Yeah.
He started, I think, in 65. 65 means 35 plus 25. How much it is? Like 60 years.
60 years.
60 years of writing. I think that is the best 2 pages. Great, good, gruesome. Where he has thrown his entire style. Okay? And from there only the QGLP is derived actually.
Okay.
So what he says, there are 4 things he said. He said, first thing, we do what we understand, which is the 99% of investing. People want to do what they don't understand. Okay, so that's very powerful. In fact, in every walk of life, if you maintain this discipline, don't do anything what you don't understand, particularly in investing, you'll be extremely well off. Second, we buy the companies which have a great economics and likely to remain great in the future. Third, it is run by competent, passionate people with highest possible integrity. Fourth, it is reasonably priced. It doesn't have to be very cheap. It has to be reasonably priced. So these are 4 lines. Okay, now let's go one by one. People, the business, what we understand. Okay, so what is the business we understand? Most of the time, when you talk about, when you are young and you are like new to the this investing, your knowledge is very, very shallow. You don't know even how to read the balance sheet. Okay, so since I'm an accountant, chartered accountant, so I start everything with the balance sheet. Okay, and generally, the moment I know that what they do, I have some inkling of what could be how good or bad could be the business. Then I read the balance sheet, and from there I get surprised, or either it is up as I thought, or I'm positively surprised or negatively surprised. So then comes a good business. What is a good business? So good business is the business where return on equity is high enough. So your, say, bank deposits give you 7-8%, 5, 7, 8%, 10%, or your cost of equity is 12, 13%. The businesses which return more than 15%, I would say, they are good business. Like your banks, all the well-run banks like HDFC, ICICI, they do about 17-18%. That's what they are. So they are very good business, but they can deploy lakhs and lakhs of crores for 17%. The banks are very large machine. Their return on equity is 17-18, which is limited, good, but not outstanding. But they can, good thing is, they can deploy like any amount of money at 17%. So it's a good business. What is a great business? Where return on equity is 100%. Nestle, 100%, but they cannot deploy a lot of money. See, God has also, God doesn't give you everything to every company.
Yeah.
So if the company is very good in terms of quality, typically they cannot deploy a lot of money. And if you can't deploy a lot of money, you cannot earn a lot of money. So your quality of So money required to earn money. The best company is what? The company doesn't require capital to earn capital. Like Motilal Oswal is a company, we started with no capital. We make money out of no money. Okay. So Nestle, Lever, Hero Motocorp, Asian Paint, they literally make money out of thin air.
Without any additional capital required.
There is no capital employed. All money is sitting in their bank. They don't use any capital. All the great companies in the world, they don't use capital. They will put in R&D, they'll put in infrastructure. But basically the business is running without capital employed. Okay. So those are greatest possible business. But there are very few in every country. There might be 10, 15, 20 companies. But they'll be different in different country. Then you have the good, the large this is 1%, 2% of the listed companies. So you can say 25 or 30 great companies will be there. Then comes next is all the stories are about these great companies. Okay, then comes the good companies, which might be 100, 200 types. Say next 10% of the companies, say you have 2,000 listed companies. So out of that, this say 50 great companies are there, 150, 200, you'll find good companies. Anywhere between 15 to 25% return on equity, or more like 20%. About beyond 20, it starts becoming great in my mind. Okay, so, but 80% of the companies are gruesome companies. This you have to understand very well. Every country has this list of gruesome. It might be anything. What is gruesome company? Those who don't earn cost of capital and actually profitable. The real trap is, see, if it is something is loss making, in any case it's bad.
Yeah.
But the companies are profitable, but they don't earn cost of capital. They are real trouble. All the government companies typically, they are in that category. They make profit, but they'll make 7, 8%, 9% because they have other social objectives. So they don't maximize the profitability. And there is no entrepreneur to whip the profitability. So these companies, they are the biggest, wealth destruction pit, where, if to earn 10,000 crores, if I have to put 1 lakh crore. So what happens is, in a 1 lakh crore capital employed company, you are earning say 5%. So how much you make? 5,000 crore profit. But absolute profit is 5,000 crores. How can you say it's a bad company? Okay, but every manager wants to double the profit from 5 to 10,000 crores. So when you want to go to 10,000 crores profit, and if the character of the business remains same broadly, you need how much money? Another lakh crore to earn that 5,000 crores. So you are earning 5,000 crores, but you have to first today put up 1 lakh crore. So it becomes a bottomless pit of capital destruction. And that's where you don't create wealth. Because risk-free is at 8, 10%, and you are earning 5. Deceptive, it is very deceptive. You are profitable, but you are bad company. So the people have to avoid at any cost going into those companies. But 80% of the entire retail money is stuck there. Not only retail, everybody's 80% is stuck there. My job is to see that I have a zero money out there. The moment your portfolio is all made up of good and great, and you have avoided this gruesome, you are already into very rapid wealth creation process.
So if I have to use a screener and,
you can do it all. It's very easy.
ROE.
But first thing is understanding.
Understanding.
See, investing is all about framework. When you start, even as a young chartered accountant, young MBA, you have zero idea of framework.
Understood.
You have been given tools, say tables, additions, minuses, this, that. And in MBA and all, they have told you, Michael Porter, how to analyze competition. But you have still not faced how to use it. So then you start collecting the frameworks one by one. So now I remember my 84, 85 when I started, I was very passionate about the stock market. But except for EPS and PE, I didn't know anything. And yet we call ourselves analysts. So analyst means what? You have the frameworks.
Yeah.
Isn't it?
Otherwise it's just speculation.
Otherwise you are what? No, you are just a tabulator. See, then the computer is doing all the job.
Yeah.
So you have to have the frameworks. So Buffett and Munger, and every good book, good investing book, will give you one framework if you are lucky. So if you read 500 books, and out of that, say 1/3 of the books are good books, so you will get 150 to 200 frameworks.
And then I have to choose one.
Yeah, so now, then you have to become master of using They are like tools.
Hmm.
So you have to use as a master craftsman at a given situation which tool to use to analyze.
Right.
So that's where the difference between us and say Buffett and anybody else who is very successful, that comes in picture. So you have to figure out great, good, gruesome. So there are 3 types of businesses. आप ये 2 पेज पढ़ो, you read these 2 pages. I'm telling, I even read now, I still get goosebumps. 50, 60 times I must have read. Because the power of his writing, his words he has chosen, is so powerful. I've tried to explain, but you read that. Then only you'll get what is a good business and what is a bad business. It's very simple. You have to avoid the bad business and invest in good business. Now, good business run by good management, bad management.
Yeah.
So we have to first figure out what is a good business. So first thing is first. First you figure out the good business. Then you figure out whether management is good or not. Now in management good to be, there are 3 qualities. Again, Buffett framework. First is whether, as per him, the order is competence, passion, and then integrity. In my order, it is integrity first. Let's see the integrity, because business is good. So if integrity is there, then only I want to spend my time. Otherwise, if his reputation is bad, I just don't want to bother about it. Then comes is the competence. And competence is also mixed with the, what has been his performance. So you will come to know, you can data-driven, you can figure out the competence. And then passion. How much he's passionate about his profession. There are guys who are very competent but laid back. I don't care. Maybe dad has given the business, or I've done enough here, I'm tired. Quite possible that can happen. But there are guys like us or younger guys who are very passionate about their business. So the competition is between passion and passion if everything else is taken.
And this we'll get to know only if we hear to the earnings calls.
That's where not earnings call, interviews or one-on-one meeting.
Which is not possible for small investors like us.
Yeah, but nowadays the earnings call and Q&A is pretty good. The transcripts and all are there.
Yeah.
You can figure out. So you have to figure out the competence, passion, and integrity. So once you have the good business run by terrific company, 99% it is done. Market will never overvalue it. Never say never. Sometimes yes, but generally these kind of outstanding companies are vehicles for outstanding investment in the future. Then comes the growth potential.
Yeah.
Now growth is always, I'm learning still how to figure out. From 91 I have started trying to figure out this growth conundrum. And still, so, growth, understanding the possibility of growth. See, in a country, India is a compounded country.
Yeah.
So last 40 years and next 40 years, I don't see any difference. I don't think it will be any different in terms of pace of growth. Now, within that, some businesses will grow at 1 time GDP, some businesses will grow at 2 times GDP, some businesses will grow at 3 times GDP. And some businesses will grow, obviously, half GDP or 0.2 GDP. Because ultimately, GDP is made up of good business and bad business both.
Average.
So we have to figure out in that, which are the businesses which are going to grow faster. Okay, so like tech in last 25 years has grown much faster, maybe 2x, 3x to GDP. Now so we have to figure out growth businesses, then growth companies.
What's the difference?
So growth businesses means tech is going to grow very rapidly. But within tech, which is the best company, like TCS, Infosys, Wipro, you have to decide which one. Because every company, see, there were 50 companies when the growth started in 95, 97. There were 100 companies in tech, but only 3 or 4 survived. Infosys, TCS, Wipro, and SCLT. Only these 4 or 5. Rest all, they just fell by the wayside. So we have to pick up the right vehicle also. For one HDFC, there are so many failures.
Yeah.
HDFC went from 1,000 crores to, say, 10, 12 lakh crores.
Yeah, how do we identify these companies that will grow their earnings at a reasonable price, at a reasonable percentage?
So, these companies are few and far between, and you have to keep looking. It starts with the quarterly result, and then reading balance sheets, reading newspapers. I think the biggest source I find is the newspapers. One is gathering the frameworks or improving upon the existing framework, is from the books. Newer and newer books, they'll keep improving because the world is improving in understanding growth, understanding valuation models, how the markets work, how to understand growth. Those things will keep improving. So that you pick up the particular framework part, you pick up from the theory part, you pick from the books. But where to apply, that comes in the newspapers. So in newspapers, so I read 4 newspapers in the morning.
Wow.
Economic Times, Business Line, Mint, and Business Standard. So, and then Times of India. So that broadly gives what is happening where. Because, so the company, say one newspaper, say Business Standard might be a little stronger on, say, picking news from Central and Eastern India. A Business Line would be stronger in the South. Mint would be stronger on North. And it is generally all over, but West dominated. So anything happening, generally it will be captured by all the papers, but some papers will exclusively cover it. So then you've got to be have an eye on that. That, okay, there is something unusual happening here. And you should be able to very quickly analyze when you see quarterly result or something, how much profit is making, what is the ROE, then and there. And then move to the screener or something. And then you have, see, the moment you have picked up the company to, or trend in the businesses, see, one of the things is that business trend keeps changing. Okay, something which is dead, say, one of the things is like real diamond. Real diamond was, all the way it was doing well, and now it is broken. Now, lab-grown diamond is coming. So there is a decline of one business, and there is a vertical rise of other business. You see, the telephone, the box telephone was doing very well. MTN was, there was so much of scarcity, it was taking many years to get a telephone. And then it became dead. It is not worth the copper in the ground. You know, today what has taken off? Cell phone. So you have to have an eye, what is the next big thing? You know, so that you keep seeing, observing, talking. So observation is very important. And then you find a trend and then try to figure out, is there many company? There are 4,000 companies, all these companies are listed somewhere. And then you go and analyze that and then go about forming your judgment about the company.
So you also mentioned that, in the wealth creation reports is only that earnings is not good all the time. Like the earnings growth is not good all the time.
Yes.
Can you explain what it is?
Yeah, so if you say, look at, say, HDFC Bank. Now, HDFC Bank started in 96 or 97, it got listed. Since then, first 15 years, I would say first 10 years definitely grew at about 40%. Then next 10 years, it grew at about 30%. Then as the base kept on growing, they started slowing down. So, last 10 years, it would be more like 18-19%. The least it grew was 17%. And last year, finally, it slowed down to flattish. Okay, so the growth pattern also, whenever the idea is new, the growth is like 100-200%. And then the growth keeps slowing down. So, but the market doesn't know what to build, what is ahead. So market sees this quarter, next quarter, quarter after that. And so suddenly, the businesses build out of nowhere, like NVIDIA. I didn't know how to pronounce it 3-4 years back. Today, NVIDIA is the largest company in the world, and it has been still growing at 70-80%. So from $5-10 billion company, it has become a $4.5 trillion company, biggest in the world. Whereas Microsoft is also 4 trillion plus, but it's a company which got listed sometime in early 80s and all. So it has been, the compounding is continuing of 25-30%. So that also, initially it must have been growing at 60-70%. Then it came down to 5-10-12%. Then again, with the cloud and all coming in, again it is picked down to 25-30%. So the business had its up and downs. So as a businessman, I know no business goes in a straight line. So when you do 20 years or 10 years, you might say this company has grown at 30, like NVIDIA has grown at 36% the stocks. It is 5,000 times up in last 25-30 years. But bulk of the earning, bulk of the growth has happened in last 5 years only.
Interesting.
So very high growth will not continue for a very long time. But markets are not that smart in knowing, even entrepreneurs don't know. The tailwind, what happens is that tailwind changes everything in growth. So, say you are doing a business and say like we are doing all capital market related business, asset management and all. So till 2020, we were growing at about 10, 12%. And then suddenly the customer base started expanding by 2-3 millions per month. From 40 million, it has gone to 200 million. So in 5 years, it has become 5 times. We have exploded. So for first, I started this company in 87. So first 30 years, it was very good for us, but not great. But last 5 years, great. You understand what I'm saying? But it will not remain great forever. It will also slow down. But when, I don't know. Market will, so market extrapolate. See, market is extrapolation machine. Whatever is happening in last 1 or 2 years, they will take it little more, 5, 10, 15 years. But it doesn't work like that. And that's where the market has to keep adjusting every day. If the opinion, today's opinion is today's price, tomorrow's opinion is tomorrow's price. If today market thinks it is going to grow at 100% for next 10 years, it will give that fabulous valuation. Tomorrow, if there are 2-3 mishaps and results come out bad, then they will say, no, it is not going to grow at 100%, now it will grow at 50%. But then that adjustment has to happen. So the market is all about today's opinions, today's price, tomorrow's opinions, tomorrow's price.
Got it. So can you also explain, what you meant by growth traps and the quality traps here?
So, as I said, the basic two sources of wealth creation is, of course, quality has to be there. If there is no quality, there is no wealth creation.
Yeah.
But quality only is very, say if you're a doctor and you have one clinic and you have no expenses, 1 or 2 staff, and you are making, say, every day 1 lakh rupees. In a year, you'll make 3.5 crores. Okay, of that, say, 20-30% you spend on those stuff. So you make 3 crores profit. 3 crores on nothing, just a room. Fantastic. But can you go from 3 crores to 30 crores? That is growth. So when you have instead of 1 shop, you have 30 shops, then you become growth company. So so this 3 crore, if it is only 3 crores, then it's like a bond. If it is 5%, you'll 20p मैं दूंगा, 3 into 20, that will become 60 crores value. Value of the company is 60 crores, period. Growth. Now this 3 crores is going to go to, say, 30 shops. He is going to make 100 crores. Now what will be the valuation? Valuation will go to 100 into 20, that will become 2,000 crores. But he says, boss, this 30 is very good. Now I want to do 3,000 shops. So value comes, quality is there, the concept is quality, but growth adds to the value of the company. Okay? Now, when you interact both Q and G, so what happened was there is a history of this. So markets till about 1950, see the evolution of the market, you see, read the history. Till about 1955, it was all about dividend. All about dividend. Whosoever pays higher dividend, in fact, the equities were valued based on the bond valuation. If bond is giving me 8%, equity should also give me 9% dividend because it is a risky investment. That 9% dividend yield में आपको share मिलता था. That was in till 55. Yes. Then slowly people realize that, boss, they don't pay out everything. They reinvest and then the company keeps growing. And hence, we should be a little more careful. We should focus on the earnings rather than dividend.
This is what
then
Warren
the P
Buffett
multiple started. Yeah. Okay. No, Warren Buffett is third stage.
Oh, okay.
Then in 60s, then this Charlie Munger came. In fact, Buffett was the bhakt of Benjamin Graham, who was all about nets, where I can buy assets at a discount or earnings at a discount. Then came Charlie. He said, it is not about the earnings, it's about the quality of earnings. Quality of franchises, American Express, Coca-Cola, See's Candy. That's what is being bought by. So in fact, Buffett's biggest mistake was buying Berkshire Hathaway because it was a very low quality, gruesome business, bought at very good price. Yeah. But he got stuck. And it took 10 years or 12 years for him to get out of it. And who held him getting out? Charlie Munger. That's why Charlie Munger is called architect of Berkshire Hathaway. He taught him quality investing. Okay, so he got converted. Buffett got converted, but of course he was executing. So then the quality culture came in. And even duffers like us, we started learning from their annual reports. And the books started coming in 90s and 2000 and all. And the whole world became quality investing. Okay. Then came the quality and growth. So by that time, growth was always popular, but there is a still gap in Q and G. So in 2013, I understood this quality and growth. So quality I had understood, but having only quality, buy at any price, highest quality, low growth doesn't work. And that's where the growth. So the true wealth creators, the high quality, high growth, that is the real wealth creators. Okay, markets are very, see, quality everybody knows. But growth nobody knows because they don't know the compounding. So when the quality interacts with the high growth, it leaves value on the table. And that's where the maximum money is being made.
What is the transitory?
So now you have the high quality but low growth. So you look like a fantastic company, say like Nestle or some other company, but growing at 5-6%. And you are trading at 70-80p because it's a great franchise. One in a thousands. So you already valued it. Now you buy at 60p or 70p and the damn thing is not growing. How will you make money? So your earnings differential, you buy at 60p, you sell at 60p, but your earnings have grown only 6%. You're stuck with a great company.
Yeah.
You're not lost money, but you're not made money. So that's a quality trap. Okay, now here growth, what is the growth trap? You buy a useless company, but growing it very rapidly.
Example?
Like there are a whole lot of companies, they come like a fire, or they might be manipulated. Or it's a very low quality business where return on equity is 5-7%, people are pumping money. And so the quality of business is very bad. Say they are earning 5%, but they are growing very rapidly because demand is massive. So there is a lot of growth. So 5,000 grows to 10,000, 10,000 grows to 20,000. But you are pumping a lot of capital in that. So it's a useless business. So there is a growth, but low quality growth. Market gives a lot of value to that. And that's where you can be stuck because the growth will not sustain. If your ROE is 10%, you're growing at 50%, from where the hell will you bring money? And then finally, they end up doing some stuff, and in a lot of internet companies are like that. Most of the internet companies, startups are like that. Very bad business, growing very rapidly. So, and you buy at some fancy price. Last round was at 6,000 crores. Last round was $10 billion, $20 billion. And globally, you lose a lot of money in this kind of situations. High growth, low quality. In the hope that quality will improve. And it never improves. So that's a growth trap.
Got it.
Okay. And if it is a bad quality and bad, growth, then it's a will destroy us in any case.
Understood. So the third metric in QGLP is longevity.
Yeah.
So could you also explain like what in terms of, I understand now first I have to look at quality, then I have to look at earnings growth of the company. Now, I think longevity is about how this quality and how this earnings growth will be sustained.
Yeah.
So could you, I mean, I think you've also given this graph in your
period, yeah.
Could you also tell us like how to read this graph? And here also you've given an example of Cipla.
So see what happens is, as I said, markets expect. See, market cannot do anything in perpetuity. Though the companies are for perpetuity. Say any company, good company, if it is profitable, like banks or stock exchanges. Stock is like Bombay Stock Exchange is like 150 years old. Okay, it is going on. It's not growing that much. It's really small. But the concept of equity is 150 years old. So you have to figure out which company could be 40, 50, 100 year old in the going into the future. It's just a call. So that starts from the industry itself. So most of the consumer businesses, services or products, they are longevity because consumers fundamentally don't change. You are eating the same chapati, same vegetables, same pizza, same. How old is pizza's concept? Might be 400, 500 old. Burger, McDonald's might be 100 year old. But burger concept might be 200-300 years old. McDonald's didn't discover burger. It just industrialized it. Burger concept was there and he made it very fast. He made it mechanized. But burger concept is 200-300 years old. So it's the ultimate burger company in the world. You know, so it's already, I think, 100 years old and it might be another 100 years. People keep eating burger. They might be using AI, but they eat burger. So, you know, what happens is some of the business concepts, they remain perpetual. Okay, so there is a, say, Microsoft. Now, Microsoft, Excel, and all these things have become a language in the head. I mean, they are like literally civilization, you can say, part of the civilization. So unless something comes and disrupts it, I see huge longevity. So you have to figure out the longevity of the concept. You don't have to stress that much, but generally consumer businesses, that's why they're more valuable. Because the longevity of consumer companies run well will last many decades.
So when you talk about consumer business, it's both from the quality and earnings growth also.
That part is clear. Q is taken care.
Okay.
Now you're talking about longevity of growth and quality both.
Yeah.
So there are some businesses which could be, say, like fax business. It's a technology has a lot of short cycles. Only Microsoft has lasted much longer. But generally, say fax, it came in 90s and lasted for 10, 12 years and out. So like relevance of fax is what? It's still there in use, but it's not a growing industry. But when the fax came, it was like a innovation, huge innovation. So you suddenly get 5, 10, 15 years of burst and then some other usage come in. So the longevity of those, so the markets are always apprehensive about every company like that. कि भाई 5-10 साल चलेगा and then after that it will subside. So the market says the competitive advantage period for this company. So this company will keep making superior return for 10 years. In their own judgment, they will say that Motilal Oswal will keep making this fantastic return for next 10 years. After that, when it happens, we'll see later on. After 2040, whether they make it or not. Right now, I'm valuing you for till 2040. In any case, present value of whatever you do in 41, 42 is very less. That's how market generally works. In fact, it is 5 to 7 years. In normal time, market discount next 5 years or 7 years. In a very optimistic time, only they discount 10 years. That's what some studies say. So basically, you have to see whether the longevity in your mind and the longevity built into valuation, is there a gap? I'm thinking of businesses, because my knowledge of the business, say in capital market business, in my mind, it's literally, these businesses are going to continue in slightly changed form for next 50, 60, 100 years. Because the concept of equity, concept of debt, they're all going to continue. So in my mind, successful capital market companies have a huge longevity. But because the earnings are a little up and down, market doesn't think so. So there is a gap. In my mind, the valuation of capital market companies are far higher than in the minds of market. Because market sees the fluctuations. The moment earnings break down, they say it is useless.
Understood.
You get it?
Yeah.
So
absolutely.
the longevity of the concept or longevity of the companies are dependent on the longevity of the concept of business and longevity of the way it is being managed. Some managements are very smooth, like Tata's. They'll do everything very smoothly. So if they get a concept which is longevated, then Tata's are the best management. Because they have that subtle way of doing it. They are not in a hurry. Who's there for them to earn? They're working for the trust. So they have a lot of patience. Their style is, do it at a pace. But everybody is not like that. When I was younger, I was also in a hurry. Today I have become a little more like Tata's to some extent. But earlier, I didn't have that much patience. We want to grow 100% every year. Tata's don't want to grow at that pace. So they will build. They'll build. And they'll live for many years. So that is what market values. Because it's all in the mind.
Yeah.
What actually happens only time will tell. But today, see, market is seeing the future. And today it is discounting the future in their own judgment. As I said, today's opinion is today's price. So if they think I'm a useless fellow, I'll be up and down, so they'll discount me like that.
Yeah.
So a lot of it is data. How competent I am in terms of my ROE, at what pace I have grown last year, they're all in data. That nobody can fudge.
Yeah.
But the thought process that this company will survive for next 100 years or this company will survive for only 10 years, that is in the mind of the market.
Yeah. It's the same for the earnings growth as well, if I'm not wrong. right? The same kind of sustenance.
Yeah,
And the
sustenance. So
understanding.
that's a call of on the business and the management and the so earnings is far more treacherous. I can tell you this. Survival is much more easier, but the earnings growth call, because when will it stop? Because it could be not only because of the business, it could also be some regulatory thing. SEBI might say or government might say you are not allowed to earn this much. What can you do?
Online money businesses.
Online money, and or maybe there could be technological disruptions. We were doing conventional broking. Zerodha came and said nothing doing. We'll do everything online. So they became bigger. We survived. But what I'm saying is their earnings are not guaranteed. So that is also a matter of judgment.
Understood.
Yeah.
And that comes by reading newspapers, as you said.
Yeah, so it's
and
then
having
experience. Then you start becoming better. In everything you have to keep learning. There's a lot of, so that's why you become a very good investor after 30, 40 years. From day one, you can never be great investor. But there is an attempt. There is an attempt to become good investor right from day one. But you can't be.
Yeah.
It's a process of learning.
Yeah. So the last one is price. I think you also keep telling that price is something everyone knows in the stock market, but value is not something nobody
so price
knows.
is all linked to the value.
And when we are talking about these good companies, I'm sure that these will not be valued at a reasonable price or the discount price in the market.
You'll be surprised. There is a frontier of overvaluation. The market is also divided in three parts. There is a frontier which is overvalued. There is a frontier which is bulk of it is fairly valued. And there is a frontier which is grossly undervalued, misunderstood. So the masters, they go to the third one. So markets are not perfect.
Yeah. How do we analyze whether the company is, reasonably valued?
The moment you have estimate of value, then you know whether stock is done well or not. Particularly when the stock is passing through, companies are passing through a adverse phase of a news item. Say growth is slow. The industry, like consumer is slowing down. Consumer demand is weak in India. So obviously all the consumer stocks are beaten down. They must be at their 5-year, 4-year low. Or they might have not done anything in the last 5 years. Market chases growth. I mean, money will go where? Where there is 30, 40, 50% growth. Say all the energy transition, all the solar companies, they're growing at 50%, 100%. All the stock, everybody wants to buy that. Who wants to buy the company which is very great, but growing at -5%? Nobody wants to look at it. But you have an insight that today it is degrowing at 5%, but I think from next year onward, it is going to grow at 25%. So there is a perception mismatch between the market and you. Now it is your call. So you'll buy it cheap and you sit through.
And for this, the usual valuation tools like DCF, discounted cash flow.
Everything helps. See, you should be master of your own tool. My tool will not help you. Your tool will help me. Because you have built your entire thinking around that particular tool. Like EV to EBITDA doesn't work in my head. EV to EBITDA doesn't work in my head. Yesterday I was there somewhere. He was only telling EBITDA. I said, give me the PAT. Because it just doesn't work for me, EBITDA. I want PAT. And what is the capital employed? Net worth. Then only my head will work. Then I can give you some estimate of valuation. And then we'll give us the growth. So the value also had 3 stacks. Breakup value, franchise value, and growth value. In fact, this is a very, very important concept of understanding value. So price everybody knows. So we have to understand value better. So one of the framework is QGLP. Second is, how do we arrive at value? So there are 3 sources of value. One is the breakup value. Say a company has a net worth of 2,000 crores. Say my company has a net worth of 12,000 crores. So 12,000 crores, and if I am earning, say, 25%. So you don't get 25% everywhere.
Yeah.
You get, say, 8, 10%. So up to 10% growth, my price to book should be 1. Because that's my breakup value. Okay. The moment I start earning more than 10%, you go to 20%, 25%, 30%. Then there is no further capital employed, but you are earning that much extra because of your specialty. Your unique formula, your unique minds, your unique process, your some IP, because of which you do much better. You have pricing power or margin power, whatever. That is a franchise value. So that itself will take, say if it is 8% breakup value, so at 25% it will give you 3 times book. Now, but that is not for growth. Then there is a growth value. I'm growing itself 50% by chance. No?
Right.
Then again the price to book changes. And then further changes longevity growth, L. If you think this 30%, 40% growth can continue for next 10 years, you have that insight, then you have to give even more higher value. So that is how the value stacks up in the mind. And then you see the price. If as per your value is $1,000, but the price is 200 rupees, 100 rupees. Another crazy thing, in the market, price is known to everybody, but 1,000 rupee thing could be bought for 100. And 100 rupees thing could be sold at 1,000. Because this is a market of people. Everybody knows the price, nobody knows the value. And that's why you have the mismatch between at what prices particular value is selling. You have to be analyst to figure out what value is selling at what price. You getting what I'm saying?
Yeah, absolutely, absolutely. So I think we're also running out of time. Just last one question. I think every style comes with its own opportunity cost or trade-offs. So what is the when someone is choosing this style of investing, growth, quality investing, like what is it something that they are losing when they're actually?
See, if there are a million guys, there are a million ways of making money. This is my way of making it. The way I have evolved through my wealth creation studies, which we are talking. See, there is something to learn for others. Okay, they don't have to do the entire hard work again. But they have to do their hard work to find their own style of investing. What do they call it? My QGLP, my something. And that will be different. In fact, even if they do QGLP, the factors they look for every component will be different. Because all of them, they have the different contexts. So everybody will find their own way of investing, but you learn from all the masters.
So just last one question, because the new age tech companies or the digital companies, I think when you talk about quality, there itself they'll be filtered out.
So, no, it won't be filtered out.
Because the ROE will not be...
No. So that's for conventional thinking. But these are the companies which have a crazy way of accounting. So customer acquisition cost is all debited to the P&L. And that's why they look a lot more loss making, but they're not making losses. They're all sinking, they're debiting customer acquisition cost, which probably under some accounting could have been capitalized.
Yeah, but for a traditional company, the fixed cost is actually going to the balance sheet.
So that differential we have talked about in one of our valuation study.
2021, I guess. Yeah. Absolutely. Thank you so much, sir. It's been wonderful talking to you. Thank you so much for sharing your knowledge with us.
Thanks,
Thank
Satya,
you so much.
And really, you have gone through all the valuation studies. In fact, it is all kind of coming, getting refreshed in my mind when you show me the graphs and all. Everything is part of one study or other.
Yes, sir. Yes.
But then, we have lived it. Every study we spent 3 months, so it gets actually internalized.
Yeah. I have so many questions, but I think we are running out of time, so I'll leave it to you there. So thank you so much for joining us. Thank you so much. Thank you so much.